Hello everyone, Alex Kim here. This week, silver crossed a threshold that has psychological weight far beyond the numeric value itself. Spot prices moved decisively above $100 per ounce and settled there, not as a fleeting spike, but as a sustained position. That milestone matters, but what matters more is understanding what had to shift structurally for that move to occur, and what it signals about the environment we're entering. The market doesn't provide clean signals. Instead, it provides a sequence of clues, and today we're going to connect those clues to understand why silver is suddenly behaving like a must-own asset again, what it means when silver starts outpacing equity markets, why gold is quietly doing something that undermines the old narrative, and why the dollar's next move might surprise those who assume the current regime continues indefinitely. We're also going to address the uncomfortable reality that when an asset gets hot, it attracts not only genuine interest, but also hype, leverage, and traps. If you're here for emotional validation, this isn't that type of analysis. If you're here to be mentally equipped, you're in the right place. Let's begin with the obvious headline, which is silver above 100, and then immediately move past it. Many participants will look at triple-digit pricing and conclude it's expensive now. That reaction is normal, and it's also precisely how people miss generational moves, because price is what you pay, but positioning is what you build. The better question is expensive compared to what? Expensive compared to groceries, housing, equities, the rate of money creation. That's where the analysis becomes meaningful. Before we go deeper, I want to address something that matters significantly for viewers outside the United States, particularly those in the UK. If you're in the UK, purchasing physical silver subjects you to VAT at the standard rate. For years, people have used that VAT burden as the reason they cannot accumulate silver. Here's the reality check. If your thesis is that silver is entering a new regime, you don't get to hide behind the VAT excuse indefinitely. Because once price begins climbing rapidly enough, that VAT becomes background noise. It becomes the fee you paid for the privilege of being early, not the reason you stayed late. Imagine you purchased a kilo bar years ago and were frustrated by the tax. Then silver doubles, then triples, then does what it just did. At that point, your focus stops fixating on the tax line item and starts fixating on the fact that you own ounces that other people suddenly cannot acquire at a reasonable price. This leads into a new issue that nobody discusses when silver is boring, which is security. When silver was sitting in the range where nobody cared, it was easy to treat it casually. But as price climbs, the same object becomes a different category of asset. A bar is the same bar, but the incentive for someone else to take it is not the same incentive anymore. If you are accumulating physical metal, you need a storage plan that matches the new reality. You need layers. You need discretion. You need to stop advertising your holdings by accident. Now let's pivot to the bigger clue, the one that matters more than a headline price. I want you to conceptualize silver not as a number, but as a competitor in a race, and the other runner is the stock market. When silver starts accelerating relative to stocks, that's not just silver performing well. That's capital changing its assessment. Here's a ratio that reveals what's happening. Silver priced as a percentage of the S&P 500. When that ratio rises, it means silver is gaining ground against the market that everyone worships. Lately, that ratio has been breaking out in a manner that should command attention. Does that automatically mean stocks are about to crash tomorrow? No. A rising silver to stocks ratio can occur because silver is exploding upward even while stocks drift or even rise. The ratio can signal that risk perception is changing without guaranteeing an immediate stock market collapse. But the reason I still take it seriously is that ratios change regimes. When hard assets start outpacing paper assets, especially after a prolonged era of the opposite, it's often the early stage of a much larger rotation. If you think I'm exaggerating, zoom out. In previous eras, that ratio has reached levels that would sound insane to people today. This is not a retail story. Silver isn't moving in a vacuum. It's moving because it sits at the intersection of money, fear, and industrial reality, and those forces are starting to align simultaneously. Let's discuss that industrial reality because this is where current data matters. Silver is not just a monetary metal, it's a working metal. It's embedded in electronics, electrical components, and increasingly in energy infrastructure. Industrial demand has been a major driver, with electronics and electrical demand hitting record levels in recent years. One of the largest industrial pipelines for silver has been solar. The solar industry has been consuming massive amounts of silver. That matters, because when investment demand wakes up at the same time, industrial demand stays firm, the market doesn't need a perfect storm to tighten. It tightens anyway. Annual silver demand has hovered near 1 billion ounces, with total demand around 1.16 billion ounces and industrial demand setting new highs. When you're dealing with a market that size, a few percentage points of extra investment demand isn't a little more buying. It's the difference between comfortable supply and a scramble. Supply is not as flexible as people assume. A meaningful portion of annual supply comes from recycling, and that stream doesn't magically double just because price is exciting. There are bottlenecks in collection, refining, and the time lag between deciding to sell and metal actually appearing as bars. When the market has been in deficit for multiple years, those bottlenecks matter more than the headline price. Then you have inventory. People argue about whether inventories are high or low, but what matters is accessible inventory at the point of delivery. Recent reporting highlighted major exchange inventories dropping into an uncomfortably tight range and described tightness in major vault systems after years of drawdowns. If you're hearing there's plenty of silver, but you're also watching inventories get leaned on, that's the kind of contradiction that shows up later with force. Now let's talk about the other side, which is speculation. Silver just had a surge that some outlets described as a frenzy, with huge percentage gains last year and another sharp burst early this year. That tells you two things simultaneously. First, this market can move violently upward when the crowd discovers it. Second, this market can also punish late arrivals when leverage gets too concentrated. Both are true at the same time. Here's my practical rule. When silver goes vertical, I stop asking how high can it go, and I start asking how deep could the shakeout be without breaking the bigger trend. Because that's where risk management lives. If you can't answer that question, your position size is probably too large. But there's something else most people miss. Silver isn't just reacting to hype. It's reacting to the same macro forces that are pushing gold. That includes the shift in how investors think about policy risk. Even large institutions have been increasing longer-term gold targets on the idea that private money and official money keep diversifying. When gold's backdrop improves, silver tends to get pulled like a trailer behind a truck, sometimes smoothly, sometimes with a violent snap. If the policy environment turns more towards support the system at all costs, what happens when millions of people decide they want hard assets at the same time? That's not a philosophical question. That's a supply question, and supply questions don't get solved with opinions. When silver moves like this, it's normal to see pullbacks. It's normal to see violent shakeouts. Anyone telling you it's straight up forever is selling you a fantasy. But pullbacks inside a new uptrend are not the same as a top. A pullback is the market checking who's serious and who's just chasing. This is where most people get emotionally wrecked. They buy because it went up, then they sell because it went down, then they buy again because it went up again. That loop is how you finance someone else's gains. So what do you do instead? You shift the way you think. You stop staring at price and start tracking signals. Silver gaining ground against stocks. The way gold is behaving. Gold is hovering just under a giant round number level that would have sounded impossible not long ago. I'm not mentioning that number for shock value. I'm mentioning it because psychology matters. When gold approaches a historic threshold, it pulls in new participants, not just retail, but institutions that have mandates and models that force them to react when certain levels break. The better way to see gold isn't just the spot price. It's gold relative to stocks. Gold versus the S&P has been pushing into territory that suggests the old narrative of stocks always win is losing its grip. Historically, when gold starts outperforming broad equities over longer windows, it's often because confidence in financial engineering is eroding and confidence in real scarcity is returning. Gold doesn't need the dollar to collapse to rise. That confuses people. They think gold only goes up when the dollar goes down. Reality is more subtle. Over long stretches, gold can rise even as the dollar index stays firm because the dollar can be strong compared to other weakening currencies while still losing purchasing power against real assets. A falling dollar can accelerate metals, but the deeper driver is trust. Trust in policy, trust in debt, trust in the future purchasing power of a unit. That brings us to the dollar itself. The dollar index has been flirting with a key breakdown zone. When the dollar gets weak, it acts like lighter fluid on anything priced in dollars, especially commodities. But even if the dollar doesn't collapse, the next policy choices can still push hard assets higher. Why? Debt math. Let's talk about interest expense. When a government runs huge debt loads, even small changes in rates change the cash flow reality. Recently, interest costs have been setting uncomfortable records. I'm not saying that to scare you. I'm saying it because it limits options. When interest expense balloons, policymakers start searching for solutions that often look like financial repression, keeping nominal rates controlled while inflation runs hotter. So the real burden of debt shrinks over time. In plain language, the saver gets punished quietly, so the system can keep rolling. This is where the conversation about the next central bank leadership and policy direction becomes more than gossip, because markets don't just trade the present, they trade the next policy regime. There's been growing discussion about a potential future central bank leader with deep ties to large asset management and a clear bias toward liquidity support, lower rates, and tools that can cap longer-term yields. That includes the concept of yield curve control, where the central bank effectively draws a line on how high certain bond yields are allowed to go and then uses balance sheet power to enforce it. If the bond market tries to demand higher yields to compensate for inflation risk and fiscal risk, the central bank can step in, create money, and buy bonds to hold yields down. That protects government financing and supports asset prices, but it can also weaken the currency over time and push investors toward hard assets. Wall Street tends to favor this kind of candidate, not because it's independent, but because it's predictable. Liquidity, backstops, support. But here's my skeptical counterpoint. Yield curve control is not magic. It can suppress yields, but it doesn't erase the inflation psychology that can build when people realize the currency is being sacrificed for stability. If we go down that path, the first reaction might be risk on euphoria, but the second reaction can be a flight to real things. That's where silver and gold come back into the center of the story. If you find this breakdown useful, consider subscribing to the channel so you don't miss how these signals evolve. Now, I want to ask you something. Do you think triple-digit silver is the start of a new era, or the final burst before a painful shakeout? Don't just drop a one-word answer. Tell me why you think what you think, because mainstream narratives always show up late. When silver was cheap and unloved, it was a relic. When silver turns violent to the upside, suddenly everyone has an opinion. We just saw headlines about speculative frenzy and warnings of a correction because silver ran too far too fast. To be fair, corrections happen. But the deeper question is whether the correction, if it comes, is a reset inside a bigger move or the end of a bubble. That answer depends on structure. Are there real persistent buyers underneath? Are industrial pipelines still demanding supply? Are investors using silver as an alternative monetary asset again? Are inventories and refining capacity tight enough that price spikes are not easily solved by supply? Recent commentary has pointed to tight physical conditions and depleted inventories after years of deficits. That doesn't mean up only. It means the market can move faster than people expect, and it can stay volatile longer than people can stay patient. Patience is the hidden edge. Everyone wants the gain. Almost nobody wants the boredom, the doubt, and the ridicule that comes before the gain. If you've been accumulating for years, you understand this. If you're new, and you're just now paying attention because the price got loud, understand what you're walking into. A market that can swing wildly and punish weak conviction. Now I want to shift to gold for a moment, because gold is often the quiet leader that tells you what the broader monetary environment is doing. Gold has been climbing with a mix of investment demand and official sector interest. Whether you care about forecasts or not, what matters is that more people are being forced to reconsider gold's role as an insurance asset, not a speculative trade. Central bank buying has stayed elevated in the last few years, and recent reports show that net purchases remained meaningful into late 2025. That matters because central banks don't buy gold because they're bored. They buy gold when they want fewer dependencies and more neutrality in their reserves. This feeds directly back into the silver story because silver often acts like the higher beta cousin of gold. Gold moves first, silver eventually overreacts. Watch the flow, not the headlines. You might be thinking, okay, gold and silver are moving, so what does that mean for stocks? Here's where nuance matters. Stocks can keep rising in nominal terms even while you lose purchasing power. Stocks can rise because money is chasing returns, because buybacks keep propping prices, because liquidity keeps flowing. But the real question is, what are stocks doing relative to hard assets? That's why ratios are so powerful. A stock index can make new highs while still losing ground to gold. Let's talk about another ratio that people favor because it's brutally simple, which is the Dow to gold ratio. This ratio has a long history of swinging between extremes. When it's high, it suggests stocks are expensive relative to gold. When it's low, it suggests gold is expensive relative to stocks. The ratio doesn't tell you exact timing, but it tells you where you are in a long cycle of confidence and fear. Recently, that ratio has been slipping in a way that suggests the pendulum is swinging back toward hard assets. That doesn't guarantee a crash. It suggests a repricing of what people trust. Silver above 100 is not just a commodity story. It's a signal that the public is rediscovering an escape hatch. It's a signal that the old framework of save in currency and you'll be fine is losing credibility. At the same time, the policy world is boxed in by debt, interest expense, and political pressure to keep the system stable. So what do policymakers do? They usually choose the path of least immediate pain. That means more liquidity, lower real rates, controlled yields, and tolerating higher inflation narratives while managing the optics, which is exactly why hard assets become attractive, because they don't require you to trust a promise. They require you to own something real. This isn't an abstract academic discussion. This is your financial life. If you're accumulating physical metal, your job is not to guess the top. Your job is to build a position that you can hold through volatility. Your job is to avoid the emotional whipsaw. If you're building any kind of portfolio, you need to think about resilience. Resilience is what survives multiple futures. If inflation stays hot, you need assets that don't get vaporized. If growth slows, you need assets that don't depend on perfect economic conditions. If markets panic, you need something that isn't someone else's liability. That's why people own gold. That's why people own silver. I'm going to say something that may bother extreme metal purists. Not all hard assets move at the same time, and sometimes the laggards can be the next opportunity. Energy is a classic example. When metals rise, it often signals broader commodity repricing. Silver surges, gold climbs, and eventually other commodities catch up as money seeks real things. But I also want to be honest. You can be early. Markets can stay irrational, they can stay slow, and they can keep frustrating you, which is why strategy matters more than bravado. We've talked about ratios. We've talked about demand. We've talked about policy pressure. So what are the next clues to watch? Watch how silver behaves around this new psychological zone. Does it hold above 100 on pullbacks? Does it snap back quickly when it dips? That tells you whether buyers are using dips to accumulate or whether the move was pure froth. Watch gold's relationship to major round levels. When gold pushes into new ranges, it tends to drag the entire precious complex with it. Watch real yields in the bond market narrative. When real yields fall, meaning inflation expectations outrun nominal yields, hard assets tend to breathe easier. Watch the dollar, but watch it the right way. Watch it as a proxy for policy confidence. A sliding dollar in the context of aggressive liquidity support can be a powerful tailwind for commodities. Watch the stories. Watch the media narrative, because the narrative is how the crowd gets guided. When the story shifts from silver is dead to silver is unstoppable, that's when you want to be extra disciplined. The public narrative lags the positioning. I want to pause and do something important for the community. If you're watching this and you've had a win, share your success story in the comments so other people can stay motivated. Does this mean the stock market is about to implode? Maybe, maybe not. And anyone who tells you they know the exact timing is selling certainty they don't have. Here's the more useful lens. If policymakers choose to keep liquidity flowing, stocks can levitate longer than fundamentals justify. But the cost of that levitation can show up elsewhere, in currency value, in asset bubbles, in commodity spikes. You don't need to predict the crash. You need to build a portfolio that doesn't require the crash to be right. There's another layer here that's easy to miss, which is geopolitics. When global relationships get unstable, countries and institutions diversify. They don't want all their savings stored in a system that can be weaponized. That's one of the reasons official sector gold interest has been persistent. Let's talk about something practical. If you are in a region where buying physical silver is taxed heavily, you have a few general routes. Accept the tax as the price of ownership. Consider legal storage structures that may reduce tax exposure, or focus more on gold if your jurisdiction treats it more favorably. The right answer depends on your goals, your timeline, and your risk tolerance. But here's the trap, which is doing nothing because it's not perfect. Perfection is the enemy of progress. If your objective is to protect purchasing power over years, you don't wait for a perfect entry. You build a position responsibly over time. What if this is a bubble? Silver can absolutely bubble. It has in the past. It can also enter long consolidation phases that make people lose interest. Both are possible. How do you guard against the bubble scenario? You don't go all in at a euphoric top. You don't leverage. You don't borrow to buy. You build a position size that you can hold, even if the price gets cut in half temporarily, because silver has done that before. If you can't hold through that, you don't own silver. Silver owns you. Here's my base case. Volatility stays high. Pullbacks happen, but the bigger trend remains supported by structural demand, monetary distrust, and policy constraints. That doesn't mean linear gains. It means turbulent gains. Imagine climbing a mountain in a storm. You're still gaining altitude, but you're getting hit by wind the entire way. The people who only trained for sunshine quit. The people who trained for weather get to the top. I want to circle back to policy one more time. When the cost of servicing debt becomes politically unbearable, pressure builds to lower rates and to control yields. That pressure is not theoretical. It's baked into the math. As net interest costs climb, the temptation to solve it through softer money policies grows. The moment the market believes that policy will prioritize liquidity over currency strength, hard assets tend to respond. That brings us back to silver's move. Silver doesn't need every investor on Earth to suddenly love it. It just needs a marginal shift in capital, because silver is a smaller market than people realize. When money that used to sit in bonds or idle cash begins to look for protection, the inflows can overpower the available float. Let's talk about the part that nobody wants to hear when prices are rising, which is that your behavior matters more than your forecast. If you bought earlier and you're sitting on gains, your job is not to get greedy and do something reckless. Your job is to protect your plan. That might mean taking partial profits if your position got too large. That might mean rebalancing. That might mean doing nothing and just holding. If you're new and you're feeling FOMO, your job is to avoid the all-at-once mistake. Scale in. Give yourself room to be wrong. Don't let a hot chart bully you into bad sizing. Institutions don't chase price. They manage exposure. I'm going to offer a simple framework you can use this week. Treat the triple-digit silver moment as a regime change signal, not as a buy now or sell now command. Keep your eyes on ratios, silver versus stocks, gold versus stocks, and the Dow to gold relationship for confirmation that the rotation is underway. Listen closely to policy messaging around rates and yields because the bond market is where the pressure lives. Tighten your operational security if you own physical assets. Discretion is part of wealth preservation. Stay humble. Markets can make you look wrong before they make you look right. Here's the big question as we end. Is this the moment silver reclaims its role as a core hard asset in the modern portfolio? Or is it just a spectacular detour? Your answer determines your behavior, and your behavior determines your outcome. Remember, none of this is financial advice. It's educational content meant to help you think clearly, ask better questions, and make your own decisions with your own risk tolerance. If you want to stay focused on what actually drives the silver market, subscribe and leave a comment with what you're watching next.